I believe the key difference between the mid and small cap part of the market and the FTSE 100 is that smaller companies have potential to grow at a higher rate than larger companies, and that this can ultimately translate into higher returns over the long term. We have a team that is dedicated to UK mid and small caps. We spend a huge amount of time meeting management teams in order to understand the businesses available to us and to try and target those that have the potential to grow into the market leaders of tomorrow. As economic growth has softened and the outlook for growth is uncertain, sentiment has turned more in favour of the more defensive large cap stocks relative to the more cyclical mid and small cap stocks. Whilst the short term may be challenging, we shouldn't lose sight of the long-term potential that the smaller companies present. We look to invest in fundamentally strong businesses that operate in attractive and growing end markets, that a number of our holdings have really excellent competitive positions and are world-class businesses. Examples would include the industrial engineers, Spirax-Sarco and Rotork, or in the technology space, Softcat, the IT reseller, or Big Technologies, the provider of remote electronic monitoring. Diversification is important. The Mercantile portfolio holds around 70 to 75 stocks. Whilst we have a high degree of conviction in our companies, the risk is spread across a number of different holdings, so that if one stock goes wrong, it doesn't impact the entire portfolio. Inflation is a challenge for all companies, but when we're looking at our businesses today, we're focusing on investing in companies that have strong market positions and ultimately which enjoy pricing power. So if anything, these companies should be less at risk from inflation than the broader market. It's always a challenge to identify businesses that are doing well just because of the current environment versus those that are doing well because they are ultimately strong businesses with key differentiating factors. Our job, of course, is to identify the latter. One of the ways that we do that is by regularly meeting management teams, and our team meets around 400 companies a year. This gives us great insight into the strengths of the individual businesses and thus helps us identify those that really have a sustainable advantage. The UK market benefits from very strong corporate governance. In addition, we shouldn't forget that the UK has been a trading nation for hundreds of years and in fact is a centre of great entrepreneurialism. Mid and small caps are the focus of this, and these businesses often grow to be great and ultimately turn into international businesses. When we look at the portfolio on a revenue look-through basis, around 50% of the revenue of the portfolio is generated domestically, while around 50% is generated internationally. So whilst the portfolio only invests in UK listed stocks, these companies can operate in a number of end markets, anywhere from North and South America all the way across to the Far East. Specifically within the portfolio, some of the international exposure includes some of the industrial holdings, such as Rotork and Spirax-Sarco, two leading engineers that are listed in the UK, but also companies such as Inchcape, the car distributor, which has operations across multiple continents. One of the really exciting things about investing in mid and small caps is we have the ability to uncover companies that are not as well understood by the broader market. This is often because there are fewer investors looking at smaller companies and fewer sell-side analysts doing the research. My team has 6 investors which focus exclusively on this part of the market, so we have the ability to explore these companies in detail and do our own research and potentially find the next market leaders of tomorrow. I think the size of Mercantile is important for 3 key reasons. The first is that because of our scale, we get tremendous corporate access, which gives us a great understanding of the landscape in which we're operating. The second advantage is that this vehicle, Mercantile, provides investors with liquid access to what can be a less liquid asset class. And then, of course, with that scale, the third advantage would be lower costs to the end investor. Overall, higher commodity prices are a drag on economic growth and are a cost to those businesses that consume them. However, they are a benefit to those companies that produce them. As an actively managed trust, we can look to gain exposure to the companies that are beneficiaries and potentially reduce exposure to those companies most susceptible to higher input costs. First and foremost, we're looking to identify structurally strong businesses, and those are businesses that can do well through a multitude of different economic environments. However, we have to be realistic. Not all businesses will have strong end markets all of the time. In the current environment, we can get exposure to those companies that do. It's important as active managers that we can adjust the portfolio to benefit from the changing landscape that we see around us. There are many different risks that we need to consider when managing the portfolio. The most simple way that we diversify risk is by holding a number of different stocks in the portfolio, currently around 70, so that if any individual company has a problem, it doesn't necessarily cause a wider problem for the portfolio. We also consider, of course, the level of sector concentration and the geographic end markets of the companies in which we're investing.